Interesting is that, I've been in business now for 17 years, believe it or not. It's actually, yeah, this fall will be my 18th year. And you see the same patterns over and over again in terms, not exactly the same companies, but the same situations over and over again. And it doesn't take you that long to analyze a company, at least at this stage. And maybe I'm wrong sometimes, and maybe the stocks I pick are just lucky. But for example, I'll give you an example. Like there were 3 or 4 stocks last year in 2009 that I didn't spend more than half a day on them, and I just bought them. And they were simple enough businesses, and the balance sheet's easy to read. You can figure out a balance sheet in 10 minutes, right? And the part of it is over 17 years, you look at enough businesses and you say, well, I'd like to own the business one day, but not at this valuation. And you have that in the back of your mind, and you always play this game. What are the best businesses in the world to own? And even before Visa and MasterCard Republic, I said Visa and MasterCard, because all it is a franchise, because they don't actually take any balance sheet risk, and IT. That's it. It's marketing and IT. That's it. And they take their 10, 15 basis points and they go on their merry way. Well, back in January 2009, for a couple days there, Wall Street was worried about all the trust data came out, and they showed a huge drop-off in spending from the recession. So all of a sudden, MasterCard and Visa were trading at 10 to 12 times earnings respectively each for about a 2 or 3 day period. It wasn't that long. It was a very short period of time. This is right around the inauguration, because I remember that Obama was being inaugurated, and I had to look at these stocks, and I had some other things going on that day too. So I remember I didn't have a lot of time to look at these. But it didn't take that long, because I knew the businesses before. I had invested in MasterCard and in the IPO. I didn't invest in Visa because the IPO pop was too high. When MasterCard went public, believe it or not, that stock actually, the initial price was 45. They priced it at 39. The first trade was at 41, believe it or not. So that wasn't as crazy as Visa. But you could have bought both. Both had clean balance sheets, and you said, okay, maybe they missed this year's estimate, but I'm pretty sure people are eventually going to want to spend money again, and I'm pretty sure plastic will continue to take market share away from cash and checks, if not only in the United States, but also globally. That's it. They're not going to go bankrupt, right? They don't have any accounts receivable risk, right? No, you could read the balance sheet. It's clean. They had some litigation risk, but it's quantified. It's already on the liability side. You just take it out. And so you say, who cares if they missed this year's estimates? They'll make it up again 2 or 3 years from now. So how hard is that? Not that hard. I mean, the part of that was the history. I had a history with that. Balance sheets, again, are very easy to read. But it's the willingness to define risk by defining risk as long-term permanent pyramid of capital versus short-term volatility price. That's the difference. I didn't care about what it was going to trade at in the next couple of quarters or even a couple of years. Because as long as I don't care what something trades at, I care about the value it has, whether it's increasing. If the price didn't move anything in the next 10 years, I'd be fine with that, as long as the operations increased in value 10% a year or 5% a year. Because it's all about delayed gratification. You just gotta monitor whether the enterprise is actually increasing in value, not the stock price. So.
You mentioned you spend about 2 to 3 hours with the 10Q when it come out. What do you do? What do you actually do?
When did I write that?
Yeah,
I must have wrote that 11 years ago.
No, it's not on the sheet. You just mentioned it.
You just said.
So let's say a company, MasterCard, comes out with a 10Q. What do you do?
No, it doesn't take 2 or 3 hours. For 10Q, 20, 30 minutes. You read the risks, you read the footnotes, you read the balance sheet. You read the conference call takes 20 minutes to read, right? And then the research reports takes another 2 or 3 hours. Because there's tons of research reports. Invariably, they just say the same old stuff. It's all short-term, very little long-term structural stuff. All I'm concerned about is long-term structural destruction of value, right? So you really focus on the risks. You focus on some balance sheet ratios, but it doesn't take for a Q. It only takes 15, 20, 30 minutes.
So you just extract a couple of key numbers.
Right. Well, I always start with the footnotes first, though. So that's where you always start. More for the case. The 10 Ks, which right now it's 10 Ks. Start with the footnotes first.
You finish the footnotes in 20 minutes?
No. You said a Q. A K takes longer. A K is the annual, a Q is the quarterly. A Q is pretty short. The K takes 2 or 3 hours. Yeah.
How do you come up with your new ideas? Like you said, they got to meet those 4 criteria.
Right.
Just cruising through newspapers, looking for stock surveys,
Right.
low points.
52-week low list. Every week, Barron's comes out. They have the 52-week low list on Barron's, but if you flip the page before it, they have 100 industries listed there, right? And they have the best performing industry year over year and the worst performing. You start at the worst performing and you work your way up. And you try to become familiar with certain businesses that you like business services. Again, that produces cash, right? Asset managers produce cash. Software companies produce cash. Insurance brokers, they produce cash. That's the business service. So if any of those fall in that criteria, and it's like the 80th to 100th percentile, in other words, the worst 20%, that might get things going. It's a sign that it's underperformed the market by definition. And then obviously you look at the number 1 and 2, which is like right now is auto and steel or something like that, the worst cyclicals around. Again, you can make money any way you want. If you would have invested in Ford a year ago, you'd make 5 times your money. Problem is you didn't know if Ford was going to be a 0 or a 13 a year later. It was going to be one of those two, but you didn't know which one. So, but you also have after a number of years in this business, you have a lot of friends. You go to Berkshire Hathaway, you have another networking friend. Everyone produces. Everyone who manages more than $100 million has to produce a 13F. So you look at their holdings, spin-offs. You look at that, bankruptcy, reorgs. Sometimes you look at that. But in general, you get your ideas from your friends and just experience. Like, again, how long did it take me to decide that I want to own Visa at 12 times earnings with a clean balance sheet? Not that long. Now, there is a risk to Visa and MasterCard in the sense that when the banks own the shares, there was basically it was demutualization from the banks. The banks were the previous owners because they owned the network before. When they sell their shares, and they sell the MasterCard comes out first because they had the first IPO. When they sell the shares in Visa in 2 or 3 years, I don't remember the exact date, then if you own Visa or MasterCard, you should be a little concerned that one of these days, JP Morgan was going to stand up and get together with Wells Fargo or Cap One and say, you know what, we're going to team up with FTC and create another network. And even if it doesn't make sense or it doesn't, it would cost $1 billion. You can start with $10 billion. You're never going to replicate the Visa network. Just the threat is going to cause prices to come down. It's going to put pressure on Visa and MasterCard. So you have to be somewhat concerned about that. But yeah, it's just experience. If you've been in the business long enough, you'll know when you see. That's why I said, after 17 years, you see the same things over and over again, and you very quickly recognize what you don't want to own and what you do want to own. So that's why, when I began in the business, I didn't understand how Warren Buffett could just get a 1-page summary from a company he's never heard of, like Ishkar, and make a decision right there. And I said, don't you have to do due diligence, dive through dumpsters, all the stuff that everyone else does? He basically he looks the guy in the eye or talks to him on the phone and makes a decision on the guy's judgment or the guy's integrity and says, okay, I'm going to bet on you, and I'm going to pay you 8 times pre-tax earnings, which is a 12 pre-tax earnings to me, 12 pre-tax return to me. My cost of money is 0. Done. Right? It doesn't take them that long. And, as I get more into this business, I can understand why I can do that, because you see the same things over and over again. You know what you like. It doesn't take that long to decide what you like and don't like. So.
Do you think Dr. made a mistake buying General Re?
I didn't understand General Re and Goldman Sachs. I did not understand either of those because he was junior on the capital structure on both of those. Either way, even if he had the senior preferred, you're still $700 billion below. I'm not sure. I don't follow GE or Goldman Sachs, but I imagine you're half a trillion to 700.
General Re.
General Re. The 1998.
1998, he paid like 3 times book using shares.
Yeah.
He didn't want to issue shares, but he paid 3 times book and issued Berkshire Hathaway shares. And
I'm impressed that you know that. You must have been like, what, 12 when that came out?
Hardcore.
I think Kill admitted it was a mistake, right? The underwriting was not very good for that for a long time.
He pretty much bought it.
But you remember he bought it with the overpriced stock himself.
Right.
So.
It was 1998. Was it overpriced?
Yeah.
Sure.
It was on the high range of its valuation.